Hi, I'm James Callad, retirement educator with Bell Bank Wealth Management. In today's video, we're going to cover some of the key principles of investing to sharpen the tools in your toolbox. One of the biggest things that I want to stress today is the importance of staying invested over the long run, even during periods of market declines. Trying to get out of the market when things look bad can lead to missing out on big returns, which can have a significant impact on your portfolio. For example, a $100,000 investment in the stock market from 2007 to 2023 would have dropped to just over $54,000 during the financial crisis. If you had stayed invested despite the losses, your portfolio could have grown to over $472,000 by 2023. But if you sold the investment at the lowest point and then stayed out of the market for a while and reinvested a year or so later, you would have ended up with only around $307,000, and not investing at all would have left you with just over $61,000. Outcomes can vary, but this shows that staying the course and sticking with your long-term strategy can pay off in the long run. Here's another way to look at what happens if you try to time the market. If you had stayed invested for every trading day over the past 20 years, you would have earned a 9.7% return. But missing just 10 of the best days drops your return to 5.5%. Missing 50 of the best days, you'd actually see a loss of 2.8%. Missing just a few of the market's best days can have a huge impact on returns. That's why the key to investing isn't about timing the market, it's really about time in the market. Another advantage to staying invested in a qualified plan over the long term is that your investment returns are typically reinvested in your plan automatically. Reinvesting allows your earnings to compound, which means that you're earning returns on both your principal and your reinvested income. Over the long run, this can significantly add to the growth of your portfolio. Taking a closer look at the effects of compounding, let's use the example of someone who started investing $2,000 in the year 2004 and then continued for 10 years, then stopped but let that money grow. By 2023, that $20,000 would have grown to over $106,000. Compare that to an investor who didn't start investing until 2014, then invested the same $2,000 per year for 10 years. By the end of 2023, their investment would have only grown to $40,457. Both people invested the same amount, but the investor who started 10 years earlier ended up with $66,000 more because of the power of compounding. Thanks for watching today's video. I hope you learned something about investing for retirement. Be sure to check out the other videos in the Your Retirement Toolbox series.